Thank you, President Betty. Well, you know, there's an old story about banking that has gone around for years, and I want you to know it's not true, and that's that story about in at 9 and out at 3 and on the golf course by 4. And that's never been the case in my 50 years in banking, because it took me at least till 4:30. Peter, he gave a short history, and I'm going to give you a short history of Kansas Bankers Association. It's actually organized February 22nd in 1887 in Topeka, Kansas. It was one of the first 5 banking associations in this country. There were 56 chartered banks, and one of these is still in operation, and that's the First National Bank and Trust of Junction City, after all these years. After World War II, the numbers leveled out at about 600 to 650 banks in the association. After the severe recession in the late 80s and the advent of statewide branching in the 90s, the charters dropped steadily. Kansas still had a good number of banks as compared to other states, and still does. The KBA has produced 2 chairmen that served as governors of this state. W.J. Bailey from 1903 to 1905, and Ben Paulin from 1925 to 1929. 3 who have served as chairman of the ABA, P.W. Goebel, J. Rex Dewey, and Earl McVicker, and we've had Earl here as a guest. He's with Central Bank in Hutchinson, and he's still a strong banker and works with the KBA and the ABA. 5 chairmen have served as state bank commissioners. In 1907, when W.W. Bowman was hired as secretary, his title changed to executive vice president in 1931, and it continued in that capacity until 1938. He was succeeded by his son, Fred Bowman, and then replaced by Carl Bowman in 1961, and continued in that capacity. Harold Stones was next and served in 1997. After 30 years with the KBA, he retired. Jim Magg took up the position and was renamed president in 2003. That's when we changed to president from executive vice president. And Jim spent 25 years with the association, and he retired in 2004. It was my pleasure to serve on the task force to elect or to nominate a new president. And we nominated Chuck Stones, who is on my left. He was nominated by unanimous vote of the task force. Chuck Stones has worked with the association since 1986. His main function prior to being named president of the association has been government relations, and he served as the association chief Topeka lobbyist for several years. He is responsible for the overall leadership of the association. He also serves on the boards of School of Banking in Lincoln, Nebraska, and on the board of trustees of the Graduate School of Banking in Madison, Wisconsin. Chuck has spent his entire year in banking, and prior to the KBA, he worked for 7 years in a bank in Wichita. He graduated from Washburn University in Topeka with a degree in communication, and also attended Wichita State University toward an MBA. He is married and has 3 grown children and 5 grandchildren. He didn't mention his dog, but I will. Ladies and gentlemen and fellow Rotarians, I present to you Chuck Stone, President of the Kansas Bankers Association.
Thank you, Dale. It's my extreme pleasure to be here today, and just so we get off on the right or wrong foot, I'm already going to just warn you that I will already break the Irish blessing, because I'm going to tell you way more than I know. And before I get started with what Dale asked me to talk about, I want to share with you a few things. I just got back from Washington, D.C. at a conference and heard a lot of political talk, as you can imagine. And I just want to share with you just a little bit about what they're saying in Washington, because they don't know. The pundits are really, if you watch TV at all, you know that they're really struggling to explain what is going on in the presidential race. They call it the wildest, most unpredictable election in their lifetimes. They say things like nobody was expecting this, and so on and so forth. And that's, you know, that's because pundits like to be on the inside of everything. They like to know what's going on, and they were not expecting the rise of Donald Trump and the popularity of Bernie Sanders. But I contend that if they'd have been paying attention for the last decade, they wouldn't have been blindsided like this. I mean, I'm not gonna be partisan here. I'm really not, because you know, Democrats and the country were promised hope and change 8 years ago, and we've seen little of either. Republicans were promised, and that you know, kind of produced the Occupy movement for a while. Republicans were promised that if they got control of the United States Senate, things would change, and it hasn't. It didn't. And so we saw the Tea Party emerge. And so there you got a whole lot of people on both sides of the political spectrum that are just fed up with what they've been promised and what they think should be happening, whatever it is you think. And so that's why I think we're seeing what we're seeing. And we've seen it for about 10 years now. So we go through this cycle, and we're going to see conventions. The Democratic convention is pretty predictable at this point because of what they call super delegates. I don't know if you know what those are, but those are kind of delegates in every state that are kind of political leaders, and they have already declared their intention on who they can vote for. Now that can change, but it's pretty rare. And Secretary Clinton has a huge majority of delegates at the Democratic convention because of those super delegates. And I think, frankly, personally, I think that is suppressing a little bit the Bernie Sanders vote because they think, why bother? Now on the Republican side, all you're hearing now is we're going to go to a brokered or a contested convention, and they're probably right because it takes 1,237 delegates to win the nomination on the Republican side. And the rules on how that ballot process really have not been written yet. They write those rules before every convention, and they change a little bit. But what will happen is they'll take the first ballot, and you've seen that on TV a lot. The great state of Kansas cast, 14 delegates for Ted Cruz, 10 delegates for, and they'll go through that whole process. And if nobody gets the 1237, then everybody is released. And I thought that the process would be that the one with the least votes would drop off, and then you'd revote. But that's not what happens at all, because you can see people, and we have seen people in the history that were not on any ballot come forward. Grover Cleveland, I think, happened that way. But you can see people that are not, and that's what people are calling the brokered convention that could cause the riots in the streets, so to speak. But it's Katie bar the doors after the first ballot. That's where you'll see all the deals being made, people making promises, and they'll take votes continuously until somebody gets 1,237. The last thing I'm going to say about politics is we also had a speech from and I forget the congressman's name, but he's the congressman that is in charge of getting House Republicans elected. And he said that in the general election, when we get all the conventions set, in the general election in November, that the entire presidential race, for all intents and purposes, will be decided by 30 congressional districts. He said once you get all of the hardline blue states and the hardline red states out of the way, the New York, the Texases, the Californias, and you get to the swing states, and then you dig down deeper and you get to the swing districts, there are 30 of them that are truly swing districts. And so the entire presidential election, from his perspective, and I believe him because they do a lot more research on this than I do, will be determined by a mere 30 congressional districts, which is a little scary if you think of that. So anyway, that's what I learned this week, and so you know already more than I do. So I thank you, Dale, for inviting me. I enjoy coming and visiting with groups about the banking industry, because as Dale told you a little bit about the KBA, the Kansas Bankers Association, is first and foremost an unabashed advocate for the banking industry in Kansas. We do a lot of different things. We primarily started to be a government relations wing for the banking industry. We were pretty much socialist in that manner. All banks get together, and instead of each of them hiring their own lobbyists, they belong to us. They pay dues, and we hire lobbyists, and we represent the banking industry in Kansas. We do a lot of education for bankers in the state of Kansas. We have seminars and conferences. Dale mentioned I'm on the board of 2 graduate schools. We sponsor those, and so we do a lot of that. We have a full-service banking insurance agency where we sell bank-specific kinds of insurance, officers and directors liability, property and casualty to banks, not to individuals, but to banks. So we have that. And then the fastest growing part of the KBA is our legal consulting area. We help banks wade through all the regulatory jungle that we see, and in some cases they pay us a little extra fee, and we have really a mini law firm at the KBA right now. So that's the fastest growing part of the KBA right now. Dale already told you we're the 3rd oldest banking association in the country. We currently have 33 employees, most of them in Topeka, but we have some employees that are headquartered out of Wichita also. We have about 290 members in the state. That's down about 25% in the last 5 years, and there's a reason for that. There are several reasons for that, and you may have read articles about that, but mostly it's what I talked about earlier, is this onslaught of new banking regulations that we've seen in the last 4 years. Technology is also a huge, as in every industry is seeing technology just take a huge bite out of their bottom line, just to keep things running, just the backroom stuff, to protect our customers' dollars and our customers' identity, to keep, and really just to keep pace with how bank customers want to interact with their bank. Apps, internet. How many of you now use the internet or an app for your banking more than you do in person? Yeah, so just the cost of keeping up with that is important. But what I really want to kind of talk about today is what we've seen in the last 5 years, because in 2009, Congress approved a rewrite of rules that touch every corner of finance, from ATM cards to Wall Street traders, in the biggest expansion of government power over banking and markets since the Depression. And they called that the Dodd-Frank Act. And why did they do that? They did that in response to what we now call the banking crisis of 2008. And in the famous words of the current mayor of Chicago, they should never let a crisis go to waste. So they used that, and that crisis was caused by an asset bubble. That one was the housing market. It was a very intertwined, interdependent marketplace, from the buying and selling of homes through to the secondary market, and then through the slicing and dicing of those loans and sale onto other investors. And it became a very, very intertwined, interdependent marketplace, as I said before. We saw a lot of subprime loans being made. Asset bubbles seem to be generational, because apparently each generation thinks they're smarter than the last one. They forget what happened in the last generation. But we've seen asset bubbles in a lot of different areas over the last several decades. We saw one in the ag marketplace in the 80s. We saw the famous tech bubble in the late 90s, early 2000s. And so they're not new, but obviously in the housing, in the one in 2008, we saw people buying houses that really couldn't afford those houses. And we saw a whole bunch of people telling those people that don't worry about it, because if a problem arises, you will always be able to sell that home and make money. And so eventually that has to stop sometime, and that's what happened. The bubble burst, and we saw the collapse of that marketplace, and the collapse of a lot of different things, including a lot of the bigger banks in the country. Those big banks were, and some of them were drug kicking and screaming to the table, but we saw big banks bailed out, we saw the auto industry bailed out, we saw several insurance companies bailed out, and we saw both of the federal housing agencies bailed out. And so that's what we got, and so Dodd-Frank was passed with the express purpose of eliminating that from happening again. And so that was the crisis, and so they didn't let it go to waste. So that was the express purpose, but all of that things, and a lot of people say that that didn't happen because the big banks are now even bigger. And so now it can be even more troubling if we have another crisis, which could very well happen. We've seen a lot of unsettling things happen in the marketplace now. But they have a name for them now. They're called SIFIs, significantly important financial institutions, SIFIs, S-I-F-I. And so that's what they called it. But they wrapped that, the centerpiece of that had nothing at all to do with the financial crisis. It was the excuse to get President Obama's and a current senator, a former Harvard professor's baby called the CFPB, the Consumer Financial Protection Bureau. That was the centerpiece of the Dodd-Frank Act, and it has been the author of ground zero for many banking regulations that we're having to comply with today. Why? So the question, to back up a little bit, why are banks regulated, or any business? Regulation is not singled out in the banking industry, as you well know. Well, it's a philosophy. It's a worldview. On one hand, you have socialism, basically, and I don't use that deridingly, but that's a philosophy of life that the people that want more regulation really have. In their end game, banks and all businesses would be a utility. They would have the government would guarantee your profit, and you would do business the way they want you to do it. On the other side of the coin, you have the total free market system. You have the libertarian point of view. And so somewhere in the middle, you have to have some common sense about regulations. And so in principle, regulators and the businesses they regulate, in this case banks, really should be partners with a shared goal. And that shared goal should be the ability to help and assist the customers and the communities that those banks are in. That should be the goal of all regulation, not to hamper that, not to stomp it down. And the key to that is trust in that relationship, in any regulation, banking included. So there were 243 new regulations embedded in the Dodd-Frank Act. And if there's a history of ratio between pages in a bill and new pages of actual regulation, the banking industry is probably going to be seeing, and about a third of it is still not done. They're still implementing as they go. We should see about 10,000 new pages of regulation by the time it's all said and done. So what am I doing? What's the banking industry doing to try to work on that a little bit? So our goal right now is to trail that back a little bit and come up with some common sense regulatory relief so that we can serve our customers and our communities. So how does that affect you all? For instance, just a couple real quick examples. We have new mortgage rules. One of them is called a qualified mortgage, QM, we call it in the banking industry, and the ability to pay. And those sound great, and in principle they are great, because everybody should have the ability to repay their loan, and every mortgage ought to be qualified in some manner. But what those have done is they've taken the judgment out of the hands of the bankers for those loans. And a few examples that I hear them almost every day is for instance, if an elderly person or a low-income person who may happen to own especially an elderly person, may own their home outright, and they are now really severely limited in being able to use that home to use as collateral if they need to make any repairs on that home, because the instant they use that home for collateral, it becomes a mortgage, which then has to become a qualified mortgage, which then the consumer has to show the ability to repay according to what the government says it has. So in many cases, those loans are not collateralized by their home. They're just made on an unsecured basis by the bank, and there's no collateral for that loan at all, and that puts that's a real problem for the bank in some cases. It's taken the time it takes to close a home loan out to about, the average now is about 60 days. I don't know if that's typical in the Manhattan marketplace, but that's what I'm being told around the state. The other thing that we work on a lot at the KBA is making sure that we can compete on a level playing ground with some of our major competitors, and I'm not going to get into that here. You've also probably seen bank fees rise some. In some cases, banks have had to reinstitute fees on checking accounts and other kinds of services, and that's because they've eliminated some of the things that banks could do that made up for some of those fees and allowed them to not charge any fees in the first place. So I just want you to understand, banks, I hear a lot of criticism that, for instance, customers are offended when they have to pay a fee at an ATM machine to get their own money back. But it takes a lot of money to offer banking services, just like it's a cost of doing business, just like in your businesses have your own cost of doing businesses. It may surprise you that just to open a typical checking account, cost analysis done by the Federal Reserve Bank costs between $200 and $250 just to go through the paperwork and the time necessary just to open an account. And then the annual costs for that checking account are between $300 and $350 in a cost analysis done by the Fed. And you may think, what can happen there? Well, think about it. You've got the infrastructure like you have at any business. You have computers. You have a nationwide clearing system. When you deposit your check in your bank, it goes out and about, back forth, and then back to your bank, sometimes digitally, but it still happens. So you have all the infrastructure to pay for. We have the technology we talked about earlier, software, ATM machines, so on and so forth. You have direct staff costs. You have ever-increasing legal and compliance costs. And then the big one, one of the big ones, is fraud. There's about $1 billion or more in checking account fraud every year in the United States, and about another $800 million in debit card fraud in the United States every year. ATM cards now cost, debit cards now cost $5 to replace. And when you see a data breach at a Target or at TJ Maxx or at any local place, the bank is responsible for replacing that card to their customers, not the business where the breach occurred. So those are the kinds of costs that are involved in offering just one banking service. So where is the banking industry now after the crisis? We've come through the recession. The economy is slowly recovering, and hopefully we're not on the breach of another one. But for the most part, banks and the economy are doing better and doing pretty well. I tell the press when they call and ask that I tell them that banks are what I call a lagging indicator. That's not a technical term. You won't see that in any textbooks. But think about it. For the most part, banks fail because their customers can't make payments on their loans anymore. So you have the leading indicators, and the economy starts to go down, and that affects our customers, the general business economy, and then they can't make their payments, so that affects the bank. So I say that we're a lagging indicator. But in Kansas and nationwide, capital is up, and that's a direct result of Dodd-Frank. That was a directive, was to increase the capital in banks. The number of bad loans are down, earnings are increasing, and more banks are increasing their lending, especially commercial lending. So you may be saying to yourselves, well, boo-hoo. I don't feel sorry for my banker. He's making plenty of money. What's it got to do with me? And I want to go back to, just for a minute, I want to tell you that maybe the most misused word in the business world is the word bank. The media and everybody else uses the word bank to talk about everything from Wall Street investment firms to insurance giants to payday lenders, but rarely is it used to describe what it really is. The word bank should really only be used to describe a business that accepts deposits and makes loans and is insured by the FDIC. All three. If any one of those are not there, are not present, they're not a bank. Maybe there's something else. They can be a financial institution, but they're not a bank. That gets misused a lot. The vast majority of traditional banks did not make those wild, toxic subprime loans. The vast majority of banks didn't buy any of those loans when they were sliced and diced. Traditional banks, like we have in Kansas, are businessmen and women in the relationship business. They're working to make their communities a better place, just like any other business in that community. They're trying to do their best under whatever economic environment they find themselves, also in the political and regulatory environment they find themselves, to help their customers, the people of their community, make their dreams come true. Whether it's to buy a car, buy a home, start a new business, educate their children, or whatever, that's what the bank is there to help with. Bankers all over Kansas are involved in almost every community activity there is. From the economic development aspects of the community, they're neck deep in United Way, Little League, 4-H, FFA, and on down the line. So finally, one more time, what does this have to do with you? I submit to you that, in my opinion, every single one of you in here ought to be in favor of an efficient, less regulated banking system. I'll take you way back. If you remember economics class, I actually blew off the dust, dug out my old economics book. And if you remember the term financial intermediation from economics, I'll just read a quote from that book that I dug out. Commercial banks also perform an additional function which other financial institutions and businesses do not. That unique function is to create money by taking deposits and making loans. Because of their unique money-making abilities, commercial banks are unique and highly strategic institutions in our economy. Some people call that the rollover effect, and most economists say that there's a 4 times rollover from the first dollar deposited until it's in game. Banks take deposits, they make loans with those deposits, and those loans are then deposited again, and then those are loaned out again. So it rolls over 4 times in the economy, and that is huge in the economy. And if a bank has to spend, and what most analysts talk about is over 25% of its resources just to comply with new regulations, that is money that is not in the economy. It is, if you roll that back 4 times, think about what that is doing to stagnate the economy if bankers are not allowed to be efficient and are having to spend too much money with regulatory problems. So bankers understand and welcome this challenge. And even though this new law will make things more difficult to operate in an efficient manner, they will learn the new roadmap for our industry and for our country, for our economy, and continue to do the best they can in making our customers' dreams come true. I appreciate the opportunity to be here. Thanks for having me, and happy St. Patrick's Day. I was hoping for a little corned beef and cabbage, but maybe tonight. Thank you.
Are there any quick questions for Chuck?